We'll start with it, and I'll just give you a background of where this discussion will lead to. There are a lot of talks about millennials and the way private banking and wealth management setups are existing as of today are geared up to meet the investment challenges and trends. To set it up, I think we'll first have to define what millennials mean. So it is, someone refers it as Generation X or Generation Y, depending on how do you look at. But the most interesting definition I've heard about millennials is one of the books I was reading, is anyone born between a period of 1980 to attaining adulthood to 2015. So this is the target segment that we are going to address in terms of their growing needs on investment management, the trends they are looking at, and how do we approach in meeting their investment objectives. So I think the first question to each of you, everyone is into a business of meeting potential investors. So you have been meeting all set of investors. So someone who has been managing wealth, or generations, past generations, or or Generation Y, which are looking for new money that has come in. So how has your experience in terms of whether we are moving from a wealth preservation kind of thing to a wealth accumulation or wealth enhancement? So I think you can start.
Yeah. If I can just take a stab at that. So I think the important change obviously is the change in confidence at the economy level itself, and which translates into various different type of consumer behaviors from a wealth point of view. So the earlier generation was obviously more focused on wealth accumulation and finding structures in which they could actually preserve it with a minimal, beating inflation was the goal really, which was set out for the wealth manager. And a lot of, I think, effort was done in managing taxes, managing various other legacy matters, family separations, which Mr. Oswald discussed. So how to create a defined pool which sort of just beats inflation, maintains itself, the purchasing power of money, and can be handed down to the next generation, because wealth got accumulated typically when a person was 60, 70, at a more defensive part of his age. Today, wealth is getting created 23, 25, 30, 35, 40 onwards. When with that comes and the economy in terms of the importance of India in the socio-economic relevance in the world is much stronger. It is now this safe haven for future wealth accumulation. And with that comes a change in mindset that, where you can take a higher risk now. So you don't want a 8% tax-free bond. You don't want a 13%, 14% LRD, or a risk-adjusted return to a developer or on a commercial deal. You're saying you're happy doing a startup investment where you can get 30% or quits. That's the whole new mindset. And coupled with that, obviously, Abhijeet can throw a lot of light as to what the HNI investing mindset is in the direct startup. But I think from a wealth trend point of view, linked to that is the change in mindset of engagement. That's what we see in art all the time, and where people are now moving from a investment for return to a investing for passion. Which means that, whether they want to collect art, which is a personal aspiration that they also see being fulfilled, whether they want to see that I'm promoting this artist and, they want to do an evening with their friends, a financial event in their home and say, hey, I found this artist, I think he's great, and why don't you come and have a chat with him and see his work, enjoy it in my home. And they feel that they've actually contributed to the growth in the journey of the artist. Whether it is finding an interesting startup in a space where they have either professional or personal background or connects. Many of these are obviously studied from an INSEAD in France and have got great global connections. And they feel that they can now add that extra alpha to that investment by not being a passive stakeholder with a 1.5% stake, but someone who can actually come on the board, use their professional network, use their personal network, use their mindset, their whole acumen of strategy to actually drive that business. So I think the big change, again from a wealth management community, is to understand that more involvement, more engagement, where the client feels that you are now on his side of the table, and let's take joint decisions. And therefore the transition also to a family office culture, where they say the wealth manager is not, there's no client and wealth, wealth manager treating me as a client. The wealth manager treats me, I treat him as a partner, and let's take joint decisions which we think are good for both of us. You obviously need to get your return, but be committed to me in the long run as well to build wealth together and enjoy a disproportionate return and involve me in the whole decision. And if wealth managers are not fast enough to adapt to this new change, I think you'll have many more family offices coming, which you as know is like a outsourced division of wealth within the whole group, where multiple family members come and run one of them, the sibling will take responsibility to run that, and which works like a cost plus model. So that will actually displace external wealth managers. So I think it's time for us to look at this, feel this change and be part of that change fast enough before many more larger families or smaller families in groups look at setting up their own practices to sort of manage that aspiration.
Okay, I think that's very well articulated. Abhijeet, you have a platform where you bring in businesses and investors together. So what has been your take on the way the new money is flowing in, or expectations from the new generation to a previous generation of what have changed? So are there more risk takers, or they want to be involvement that Rishi covered in terms of more involvement in businesses? So what is driving investment into startups and all?
So we invest into early stage up to $1 million through a network of 800 investors now. But it's pretty slow.
Okay.
It's increasing, but Indian investors still don't have capacity to do very high risk investing. Most of my investments are the people who are settled outside India.
Okay.
Maybe HNIs or NRIs. They are much faster, much more high risk taker than even the biggies of India, because I don't know, somehow that's why we are trying to get to more tier 2, tier 3 cities and get these really rich people and convince them to get them on board and try to get them investing in startups. But startup investment is it's a most high risk, right? Either you lose or you win, right? There is no midway. You have to be very patient. You have to be patient for 5-6 years. But all these tier 2, tier 3 cities are more return driven. Like I invest, I get interest, and then
a particular return.
So it's changing. At least the metros, people are getting more aware, and they are trying to invest after they have done their real estate and they have done their FDs and stuff like that. But still very slow. So I think out of 800, only 160 have invested till now.
Okay.
So you can see the idle the ratios are pretty bad. So 20% are only active investors. Rest 80%, either they will start investing when they feel like something exciting has come, or they will do it. They are not yet ready to touch startups. But it's pretty good compared to what was the situation 10 years back.
Okay.
At least now there are people who can support such early stage startups, and at least there are investors who can invest every month also. There are people like that also. So it's changing, but the speed is still not as expected as developed countries, but it's changing.
Okay.
But I think just to add, that's why it's important for the wealth management community to also understand that this is a part of the allocation that they have to plan. And Rajesh's opening remarks, I think, was very welcome, that a reputed large, one of the leading in wealth management space like Kotak has recognizing that they need to work with associations like our ventures and other associations to actually be able to do the screening and to be able to guide him that this risk adjusted return makes sense for you. Mm-hmm. So you have listed equity which can give you this type of payouts, you have your realty, you have your REITs, you have your real estate funds, and then I've got a slide later which we can discuss how the whole alternate assets fits into the whole continuum of investments. And once the wealth filters are able to project it in the wealth plan, in the allocation, and I think it's much easier for an investor to say, okay, I'm following the plan now. I'm not trying to do something which is knee-jerk, arbit, because I went for this ring session last night and everybody was talking startups, I've jumped into it. It falls into a large plan. There is a particular amount of allocation necessary for that, which will give me disproportionate return as the economy matures. Okay. 10, 20 years down the line, that's the whole belief. Many of these new businesses would have become mature. So they will give you returns which your Reliance Industries gives you, right? With a large market capitalization, even with the 4G launch, it will give you a 30% is like a dream for Reliance. Right? All the gas basins throw a lot of gas and 4G succeeds without glitches, with a great conversion, you will get a 30% upside on Reliance. Whereas if you get this startup right, or next Pokemon, you will get a 3000% return on that, right? So, it's a very different payouts, possibilities. Therefore, there's a need to allocate certain wealth in all of those. So for art, so for other, luxury ideas like, wine funds, to real estate, maybe in Madagascar. So there are various such ideas which largely fit into plans, which I think Indian wealth managers have to also mature to be able to present those type of asset allocation frameworks where these things fit in as a plan and not as an outlier.
No, so I before moving to Aditya, now you touch upon the topic of Pokemon Go. So now, for wealth industry and private banking per se, now if someone as a clientele want to invest into a gaming industry, looking at the success that we have achieved, how many platforms do actually have a ability to look at these kind of industries first, second, and then to identify market leaders and say, this has a potential to grow. So in fact, that is the biggest challenge. So do you think private banking has to evolve, or it's always a third party provider that needs to be looked at for all these outsourcing needs?
I think clearly a platform like Our Ventures, for example, has the ability to screen various such opportunities and to give you the right perspective as to, does this business plan make sense or not, and what are the odds of success. And now we are seeing it's a combination of the three. Wealth manager needs to screen such platforms and to do some basic diligence that, things are not being rushed in terms of the diligence of the platform and there's no biases in what's being thrown up. The platform will obviously do its own meritorious task. And the investor himself feels that because he has some understanding, he's come back from the valley, I'm saying he's come back from a INSEAD program, he's met, his batchmate there was son of, the leading gaming development company or something, and he has his confidence and he says, okay, I will come on board, I'll bring this guy to de-risk the business. So that joint way, I think that effort can be very successful. So the platform, the wealth manager and the client have to jointly work to create the metrics and framework in which you do a diversified portfolio. That will work. That one-off, you will not get the next Ola immediately if you just do one investment. If you do 10, 20 investments systematically, you'll get those, 2 out of 10 will be jackpots and the others don't matter then.
Aditya, you are into a very interesting business of food. So, do you think it is easy to convince people on a food platform? It's as difficult, or so if you can just take us through about your journey of meeting investors and what they look forward to, and how has the expectation changed from earlier generation to this generation when you meet young people for investments? So what is it?
Great. So I see a lot of young faces here. So I represent your side of the community. And for all the enthusiasts who really want to come on board, I think startups is the next big leap. I would encourage everybody to either be a part of the startup community or to start up themselves. That's the best bet. Coming on to the question, and I would just put on the right perspective here. So collaboration is the way forward, which Rishiraj just said that everybody got to come together. So collaboration is the key word here. As far as raising investments, I'll be very upfront. I come from a very strong background of having all the traditional Marwadi business people with whom I have worked with. Talk of Nokia distributors, Apple iPod, etc. I was never very keen to raise investment from a traditional business guy, right, who has gutka and we call them gutka family guys. So I was very keen that I got to build this business as a not as a business but as a startup, and I roped in one of the most reputed angel investors. His name is Ajit Khurana. So that is from where the journey started. Yes, it is little difficult to reach out to the right angel investor because it's kind of a second marriage to entice him with what you are going to do. And being an early stage investor, of course, there are great platforms like Our Ventures, who just, he's the co-founder, of course. But yeah, I think if you're not a part of the network, still it becomes kind of a little tedious task to reach out to the right investor who will back you up, not only in terms of capital, but also with the whole journey, giving you right industry connections, as what Rishiraj also rightly pointed out, that there are lots and lots, including Reliance, who has set up a new GenX entity, which gives opportunity to all the early stage ventures without taking anything in return, right? So I think that's a fantastic thing, because innovation is the next big leap that every large corporate got to take. And there is a typical startup way of working as well, which I think every big large corporate, talk of anybody who's in Bombay, Tata's, Reliance, Godrej, Aditya Birla, everybody is focusing on this particular community because there is a faster way of doing things. So I met, just the last bit from my side, I got to meet Mr. Harsh Mariwala a couple of days back, and he was telling that he had to build a new vertical within his team, which had a direct reporting, so that the whole redundancy and the way the corporate works, the startup didn't have to face all of this. And I think his expectation was just right. So I think that's a very obvious step. I'm not a great wealth management guru, so I won't be able to give you a lot of insights around that. But I have also been an investor. I have invested in 4 companies. So I burnt money in 2, made 17x returns in the third one, and I've just committed a couple of lakhs in one of India's largest crowdfunding platforms. So yeah, that's pretty much about it on what journey I have been through, if that qualifies.
I think you have given a very interesting perspective of you making 17x money in one of the platforms.
Right.
So it is the return potential that is driving investment into for all these, or because we are coming from a background where the traditional investments of investment into equity, debt, real estate will give you a certain percentage of investments. So are people moving from percentage investments to a X amount of investment returns? So is this what is driving money into these sectors, or people are following their passion? So I've seen like people would be, so the business, if a family business into healthcare, so they are looking to invest into a healthcare sector because they understand that business, or they want to continue, but obviously because of digital age and all, so they want to do much more than what family business would have done. So what of the two is driving the business environment right now?
Sure. So one is on the commercial side, more on the money perspective. I think the growth of money, of course, it is meant for risk takers essentially, and it also depends at what stage you are going to invest in the startup journey. So if it's an early stage investment, it's a extremely high risk and a very, very high return kind of a proposition. If you're looking at coming to a VC kind of and you're putting in $2 million to $5 million, I think it's fairly okay. And private equities, of course, everybody knows how private equity works. On the other side, which is on the reason why they are doing it, which is kind of intangible, is more on the passion or maybe to diversify. So for a corporate, I think they got to really get on to as many things as possible without losing focus on their core business. So yeah, I think that's a very obvious trend that I see, that more and more investors, even who are situated globally, are also putting in a lot of money in the Indian-based companies. So yeah, I think more should come from these two folks on how the trend is.
So basically, obviously that the reason for investing is obviously a mixed one. Some people just do it for returns because it's a high return game. So you just hear the stories that people made so much of money. So these are 17x is still lower, right? You can make even 100x in 2 years for your rooms, 100x in 2 years. So you can never get these kind of returns in any of the business. But then you have to also understand that these are very 1 in 1,000 cases, So the problem with all these, most of the bigger wealth managers or the bigger investors or the family houses in India is that I think they need to be very quick with investments, because startups are very quick, right? If you're not investing within 3 to 6 months, either they are already invested or they are shut, they are shut short. So my problem with these larger investors is they are so slow that by the time I get any commitment, either the startup has raised the investment and gone to the next level, or he's not there. So they need to really work there. The speed is the important thing here. 6 months delay, 6 months documentation, these things really don't work. And the returns will come if you do a very wise portfolio of maybe 15, 20 companies. You will definitely make much more than what you're doing in any other asset class possible. But it can't be like you invest in 5 and then you think, okay, why I'm not making money, and or if the first company goes bust and you start panicking that, okay, my money is gone down the drain. Obviously 80% of the money is going to almost maybe 40-50% of the money is going down the drain anyways. So you have to have that mindset that if I'm investing 1 crore, 50 lakhs is anyways gone. The rest 50 lakhs, some will make money, some will just recover, 1 or 2 will give you so much of money that
it will recover for rest of the
much more.
loss.
But the patience is not there I feel that patience has to increase, the speed has to drastically increase. Corporates are very slow in investments, startups really don't wait. So we have a cycle of 3 months. Either we get them funded in 3 months or we discard it. Because once the news is out in the market that somebody is raising fund, it's a bad impression also that if you're not able to raise for the last 6 months or 1 year, right? So it's a, I think there the improvement is needed quite a lot.
So on your personal investment basis, you are moved out from traditional investment of debt, equity, chasing normal equity returns and putting only on ventures, or you still believe in the traditional and you believe in risk diversification at all?
So
if you really want to diverge your personal investment.
So you obviously do the basic sanity investments like your real estate or FD, whatever, you just do the basic investment. But after that, it is I don't want to spend, I don't want to buy 3 properties in Bombay because it doesn't give me any returns, right? It gives me 10% return. Why would I invest in that? So our ventures, we have invested in almost 11 companies out of 30 we have invested. So we don't believe in keeping that money and putting in the FD and get 8% return. Rather than I invest in something which can later give me 100% or 100x or 50x or 20x. So we are totally high risk. So I am extreme high risk. Both our partners are extreme high risk. All people are not like that, but I am saying that even the balanced approach might work. You don't have to invest everything in early stage. You can buy 2 properties and then start investing.
Yeah, so I would also like to add my bit. So of course, I've been on all the 3 sides, right? So I've been an investor, I've been an entrepreneur, and everything else that is required to support the ecosystem. So of course, yes, I think the basic remains the same, that you got to have at least a property where your wife and your children are very happy and safe. But yeah, I have unwinded myself from the entire traditional investing cycle, and I put a lot of money into these startups. The challenge which I had been facing, and had I met Abhijeet and the other folks, possibly I wouldn't have burnt my money in the first 2 investments also. But like I said, these platforms help us in finding out the promising startups, which is extremely important. The way they curate it, everything I think is very fantastic. And my 4th investment is, by the way, I would also like to take the opportunity, is going to happen through our ventures, so on the crowdfunding platform. So yeah, I think it's more about passion, and we see a lot of value that we can add to these new entrepreneurs. So the reason why I also put in that capital was, to make a new Kickstarter or make a new Indiegogo in India. So yeah, that's pretty much how I have, evolved in the last 7-8 years. I'm also getting in a couple of senior partners from McKinsey and BCG who have either known through a +1 network, or my wife works with them. So I think these guys also are very high risk takers, and I think there's a lot of money that I see coming into this.
Rishi, anything?
But I think the discussion is moving from one level of imbalance to the other. So this is not a good example. And obviously not disclosing that Abhijeet also runs a fantastic development company, Pronto Infotech, which keeps his cash flow running, and his wife is in a great position herself in an MNC. So clearly, I think from a wealth management point of view, we can't obviously move from a sub 0% at one level and a 80% allocation to high risk. Clearly, that's not the objective. We need to obviously, the clients will have their own, firstly, all their liquidity needs for the next 30 years need to be met, right, from your traditional wealth management. You can't have any of that money that's required for a son's US education 18 years later, or a daughter's wedding 25 years later, to come out of angel investing. So your traditional bank FDs, to your debt, to your insurance, to your realty, all of them need to be in a very comfortable position before you get into this, because most important here is liquidity is very, very fragile in all of these assets, in all of these luxury investments. So you'll only advise it to a client when he's met practically all conceivable liquidity needs for his lifetime. Medical obviously is most important, and everything else. After that, you'll start, hopefully as an economy, if you can reach even 2% allocation to 5%, I know, so globally you have a 20-30% allocation towards alternate assets. But that alternate, I was actually keen to run a slide. If you can put on a presentation, I can go through the whole framework of alternates. But alternates, obviously, you could move to the next slide actually, please. I'll use a slide change.
I think go to the third one.
Yeah, no, this side actually. It's become a little slow font here. So just, if I could just step up. Yeah. So here, if you see that your traditional assets, your cash, your bonds, your public stocks, all of those are first going to always get largest part of the basket. And then your tangible investments like realty. India obviously has a very large pool in realty and gold. So gold is our hidden investment which nobody counts as an investment and it just keeps piling up, and it obviously has a good run up, so that's good for us, but may not really perform beyond a point. So your tangible and traditional investments always pay the largest chunk. As you move towards other investments, what this profile also says is the first 2-3 are widely used and accessible to all, including retail, and at any level people will participate in these. The next bucket that will sort of start filling up is like art, antiques. We have some allocation in India, and more allocation will come over time. And whether it's art for a passion investment, as you said, where a person wants to get involved in the journey of collecting, or art for consumption, where a person says, I have a home, I have 2 walls, I'll put some good art, which is mental accounting. I'm also putting in interior spend, also looking at an asset build. That comes next, and then the core alternate investment start, which is your private equity, venture capital, and other alternate investment, which is your PE funds, debt funds, alternate funds, some of those. So clearly, in the allocation, even if you reach, globally it is 20% plus in other investments to that, 80% is traditional. In India, even if we reach 10% or 5% in the next 5-10 years, I think it will be a great achievement for the whole sector, and such sessions like this will become more meaningful then.
Yeah, I think we are coming from a background where in India is still the equity penetration is still at 5%. So looking at alternate to reach the 20% is still a time away. So
I mean, 10% in our lifetime, we should be happy that we've done these questions.
So I think Abhijeet, you covered the promptness in terms of deciding when to invest.
Right.
But have you ever approached a wealth management platform or a private banking platform to raise money for certain investments or for businesses and all? Because as traditional private banking platforms and wealth management platforms, their due diligence itself will take months and months. And especially for someone where the control lies outside of India, it takes 6 months time for someone to get approved. Because I've come from a background where for a real estate, private equity and venture capital funds, which most of the markets have been advising clients on, or single approval may take 6 to 8 months. So have you approached, do you think there is something that needs to be done, or?
So we have a lot of smaller funds which are obviously family offices, start their own funds, and a lot of bigger funds also on board. But the problem in early stage when you're raising $1 million types, the problem is the process. I don't deny that they will require longer time to do their due diligence, they will get much into details, and but the problem is these startups, a lot of these new startups can't survive that long. Because the problem is they don't have so much of money and so much of luxury to support all the kind of due diligence, and if the money is not in the bank, it's kind of useless for them, right? Because even if you have commitment, if the money is not reaching to the bank, even the company law is now so strict, right? So even with the commitments now it takes 3 months to just close. So if you can add that another 3 months or 4 months of due diligence, it becomes a year process.
Yes.
Which a lot of these guys can't even survive. 95% will not even exist after a year. Now the difference between developed markets and India is that there the smaller investor, individual investors write such a big checks, like $1 million, $500,000. So the funds and the family offices and the wealth managers don't even come into picture until you are raising
a certain amount of time.
So you've already reached to a particular stage. In India, the problem is that even raising $1 million, you have to reach wealth managers, you have to reach private equity, you have to reach VC funds, you have to reach.
Oh, here we can't say problem, it's a good thing.
It's not a problem.
It's a bottleneck, it's a time bottleneck.
It's a time.
Because it's a conservative society, it will take time, because so I'm not saying that it's a problem from any end, it's a slow process.
No, because as a society we come from a very risk aversion.
Correct.
So we have been avoiding risk. That's why your equity penetration is so low till date.
Absolutely.
So to that extent, from
PPA
converting that from a risk aversion to completely go risk, and either look for a situation whether you make a 17x return or you make nothing.
Correct.
But here's the thing. So we are. I think this panel is more on millennials.
Yeah.
And I very well qualify to be
one of the millennials. Yes.
So it comes with a lot of belief, and we are very we are not very high on taking risks, but I think the time is now. So if we don't do it now, my question to my wife is, when do we do it? Right? So she comes from all this financial analyst and all that McKinsey background. So I think the time for us is now. And with all this momentum that is being pumped into right from the PMO's office, I think this is just the apt time for everybody to get into this space.
Yeah.
I was there in one of the panel discussions last month. I think Canada has got some 3 million angel investors. I was just, it was mind-boggling. So
61
that's,
million.
of course,
Low
Canada,
population.
which is like,
Yeah.
a very small country, doesn't have too much of population. In India, we have got so much of wealth, if I may rightly say that. So I think this trend is, but I think the speed is missing. But I think over a period of couple of months, I think it should change drastically, because there are a lot of other platforms also coming into the scene. So they are working on alumni network, etc. So I think it's only going to become better and better and more refined. And it's just about finding that one or two good ones and putting in capital there, and I think you see that change happening.
Okay. And how has been your experience with all these investors, whether they take a failure still in terms they are okay to accept a failure and then look at a new venture, or if they are invested and the first venture is completely a failure within 6-8 months, so they take a completely back seat and go back to a traditional investment? So
Yeah, so couple of guys who have either worked with or who are angel investors, most of us have played poker. So we have a poker face now, and it means that we don't want to show our expressions for guys who don't know what poker actually means, right? The other thing which I feel is worth noting is that these angel investors write off that money then and there, because they don't know what's going to happen, because it's a very early stage. But like I said, if it's a VC, you have a proven track record, you have some customers, you have some revenue coming in. So then it becomes sort of little easy for them to take that risk. But I think since we are talking about the entry level investment, I think it's very, very high on risk.
okay. I think also moving into private banking and wealth management, and you can add all these have been a platform where traditional investments and the earlier generation people that have made money and then eventually had got passed. So entire money has moved from something that is a 10-20% return, or at best that you would have made a 25% return. So something that has moved to a younger generation. So how has been the transition in terms of passing of wealth? So how quick is the transition? So
Yeah, so I think the clearly people, as Abhijeet pointed out, with the US, with the overseas influence, where at least the next generation had gone out, is able to have more conviction and more independence. And in those families we've seen the transition has been very, very quick.
okay.
Where they've sent one generation out, he's understood wealth trends there, he's understood how things move, their structures are more contemporary in that sense, have said, okay, it's your money now, go and do what you like. Where the businesses have been very family-run businesses, next generation has been very based domestically. There, the parental control and influence on decision making is still much, much higher. So that's been a much slower generation,
Okay.
And therefore the frustration I can understand from angel platforms, etc. I think the whole I don't see many families even today having that, when, let's say when Tariq came from AMICOP, having a family discussion that, succession planning, wealth planning, what Mr. Oswal said as structuring, how will the 4 generations move. So very often a lot of the wealth, because it's not segregated in structures, is still lying in joint pools.
Joint pools.
And therefore if one person is risk averse, it actually brings down the whole aspiration of the whole family.
Okay.
It is very difficult today to say, okay, we have 5,000 crores as a family, my stake eventually is 12.5%, it's 625 crores, let me at least play 6 crore out of that, it's my wish. But now the whole family sort of weighs down. So I think there's a lot more such clarity. I think the whole game will change when this association or collaboration starts with the wealth space. When these allocations are much better discussed and shared. So first has been agenda in the minds of wealth managers and advisors that, hey, my clients are doing something direct, it should go through me, because that creates the discipline of the framework. I mean, risk allocation, the whole risk reward trade-off, which should start the plan, the portfolio plan should be robust enough. There, if it covers everything, then the family will have a more balanced view and say, okay, my uncle is 85, he doesn't understand venture capital, but he trusts his wealth manager, and this plan, this 2% allocation is there, so I can play with this 10 crore kitty and either put it in VC funds or do direct punch with it. So I think that whole system is now falling in place where it should really be part of the plan. And I think it's important for wealth managers to be comfortable that this needs to be there, this should be there, and have a holistic discussion with the client. Because currently वो हो रहा है कि you know what is a घुस्सू investment हो रहा है. Sometimes we know people who don't even tell their parents कि मैंने ये deal कर दिया है. So, you know, so it's no fun like that. Right? It should be very above board. So I think that's where the whole industry has to work together.
And I think as an industry, if wealth management and private banking has to succeed, I think we need to have a product platform and the delivery which actually meets the investment objective both for a client and also for ventures which are raising money. So it's a challenging field, but I think that with times to grow, there is enough and more need, and there are platforms like AHA Ventures which can always help private banking industry to grow more. I think with this, we'll close the discussion. I'll open for any question and answers for any panel members. I think the session have been extremely good.
One question there.
There's one question there.
Yeah.
Yeah, one thing I've learned in the investment management profession is that you take care of the downside and the upside takes care of itself. Now, crowdfunding as an investment avenue is not a seasoned product, so to speak. Unless and until a down cycle happens for that particular product, do you think it is advisable for these people to continue to be attracted, or wealth management professionals suggesting that as an investment alternative? I mean, unless and until you see a downside in the market for maybe a couple cycles, only then will you see a shakeout happening. So my question is crowdfunding a sustainable business model given that it is a relatively new phenomenon?
Abhijeet, yeah.
So it's a very, the network like us make much more money than what a fund or they lose more money than us anytime, because we invest at very high risk, our returns are much higher. So, most of these wealth managers or funds, if they are saying that investing in startups, you need to look at 5 cycles, 10 cycles, 3 cycles, it's very wrong. Because here, if you're investing in 10, 15 at such a high risk profile, the guarantee of the return is definitely there. The higher money you invest in, the guarantee becomes lower and lower, because the risk becomes you don't even know that whether companies will give you any return at such kind of valuation or not. So the biggest, I think the best way to invest if you want to do in startup is at early stage, not later. Later is less returns. Early is the best return.
But that flouts with the empirical evidence where almost 95% of the investments fail. Now, what guarantees does a crowdfunding avenue have suggest to the potential investors that this is going to be your 5%? So you're exposing the client to a lot of risk without compensating return, so to speak.
No, so absolutely. So if I may add, I'm totally in agreement with you, and therefore I mentioned that this is not supposed to be your 20% or 50% of your wealth. You are putting that part of your wealth which you can write off. The aspiration of higher returns is actually already factored in or reflected in the economy. So if you look at a Flipkart to a Snapdeal to a Oyo to a Ola, were all available for funding for all of us. And if anybody had participated in any one of those, your VC investing for a lifetime would have been taken care of. So it's a multi-bet game. Globally, even the biggest of funds, when they set up VC funds and they go to the investors to raise money, and the IC is confident that 1 out of 10, 2 out of 10 are going to work, that ratio will always continue. So it's part of the whole game. So there's no way you can guarantee returns, there's no way you can protect downside. Therefore, the money that goes there has to go with the mindset that there's no downside protection, but disproportionate upside if you get it right. Now, my only challenge is you're using the word crowdfunding. That has a different connotation. It's a different business altogether, where sometimes the reward is not cash. A reward is either a passion investment or supporting a cause or something return in kind. So I'm assuming when you're saying crowdfunding, you still mean angel investing. Crowdfunding is a totally different subject altogether.
So it all depends on what is driving that investment. So most of today's generation also invests through impact investing.
Yes.
So that is anyway one.
Yeah,
But,
yeah.
but summing it up all, be it traditional investment, be it high risk investment, one thing needs to be very clear, your risk assessment needs to be done accordingly. That always used to work in a traditional investment, that will always keep on working for new investments also. So you need to be very particular in terms of what kind of risk can you take, whether you are okay to take that risk, and whether as a family, if there's a family money involved, whether the entire family is in line with what decisions you are taking. So I think with that we'll,
As a fine example, I could end that. So your realty portfolio, if you look at from 2008 to now, most listed realty companies are 95% market cap erosion, right? So you think real estate is the most real thing in the world, as Indians we are trained, and you have a Unitech which is 99% erosion in wealth, DLF is 85% down, every listed equity is 85 to 95% down in market cap, in front of our eyes. That's an example.
I think thank you. Thank you, Abhijeet. Thank you, Aditya.
Thank you.
For a wonderful discussion.